you for joining us for today's presentation entitled Spotlight on Payment Factories. My name is Riera. I am Director of Payments at Logica. Today's presentation will discuss how finance executives are examining the effectiveness of current operations across payables, receivables, treasury in response to today's weaker global economy. You will work with customers on making the case for payment factories, their sentiments about their banks, and how you respond to their needs as of 2012. 25-minute presentation followed by Q&A. Before we begin, please mute your lines. Speakers call are John Farrell and Nazreen Kibria. John is the Senior Vice President of the Logica Financial Services Division at Logica. In his role, Farrell leads the professional services and payments practice of Logica North America. Farrell has more than 15 years of strategy, operations, sales, and marketing leadership experience to Logica. Logica, Farrell was the Chief Operating Officer at a privately held firm overseeing the strategic development and execution of the company's corporate plans. Prior, he held senior management consultancy positions at Bearing Point, formerly KPMG, and PricewaterhouseCoopers, where he had a team of consultants on advisory services and business process reengineering initiatives with national corporations. And he was also instrumental in creating and developing a major industry segment within the firm. From Western New England College. Nazreen is a payment subject matter expert at Logica. Her spans the financial ecosystem from disruptive emerging consumer technologies to corporate treasury and cash management. Areas also covered as a former senior industry analyst. A track record of leading successful initiatives in finances and technology industries. She was instrumental in redefining the direction of the Association for Financial Professionals, the AFP, a key architect of the Federal Reserve Bank of Boston's Emerging Payments Research Group, EPRG. Prior, as the Director of Product Development and Management for Eliza Corporation, she played a pivotal role in transforming a former startup company to a profitable business. Here at Eliza, Kibria became co-inventor on 2 patents in artificial intelligence. Kibria holds a BA in economics from Wellesley and an MBA in finance and strategy from Boston College. Let me now go over to Nazreen.
Introduction, Pat. Good morning, everyone.
Good morning.
It's going to serve as a roadmap for today's discussion. We'll begin with a look at the current economic landscape, a background on the research methodology we used, walk Logica's research findings, some key takeaways, and share Logica resources that are available to you. And at the end of this presentation, you'll also have an opportunity to ask questions. So let's dive in. Before we begin, it's helpful to put things in context by looking at the U.S. macro economy. According to the National Bureau of Economic Research, that's an independent group of economists, that started in December of 2007 and lasted 18 months until June 2009, is the largest and deepest downturn in the U.S. economy since the post-war era. So, if we look at the economic data now, leading indicators point to the smallest of favorable signs in the U.S. economy. The gross domestic product, or the GDP, in the U.S. expanded 1.8% in the third quarter of 2011 over the previous quarter. The real unemployment in 2011 was 8.9% and actually declined to 8.5% in the last quarter of 2011, according to the Bureau of Labor Statistics. And the inflation rate in U.S., which refers to a general rise in price measured against the standard level of purchasing power, or the Consumer Price Index, that's reported down to 3.4% in November of 2011. However, as we're all aware, there are fears of a double-dip recession. On February 18th, the World Bank warned of impending recession emanating from the continual fiscal problems of the Eurozone. Justin Lin, who's the chief economist at the World Bank, he noted that Europe's probably already in recession. The World Bank cut significantly its global economic growth predictions for the coming year. And similarly, this week, the IMF chief announced that we may be headed for the Great Recession. What? 2012. I'm sorry. If you mute all your lines, it would be helpful. Thank you very much. So, as I said, what are we going to experience in 2012? Or in other words, how to prepare for the new normal? That's the current state of unpredictable environment. Well, against this backdrop of anemic recovery that we're going to examine the results from Logica's research on payment factories. By defining what is a payment factory, because sometimes it's often blurred or confused with other terminology. At Logica, defining it as a shared service center centralizing and optimizing payables and collections. So let's talk about how we conducted this study. Well, we performed primary research to examine the use, experiences, and intentions of companies towards payment factories. And we also are looking at our findings based on 157 companies in North America and Europe. The online survey was supplemented with responses that we collected from senior executives at the Association for Financial Professionals, or AFP, annual conference. Now, this is the largest event for finance and treasury corporate practitioners in North America. And as Pat mentioned, it's also where I previously worked. And broken down, that's 101 North American companies and 56 businesses from Europe. So looking at this slide, it provides some of the demographic information of the respondents, because in terms of revenue, yes, it's more skewed towards companies in the large and mid-sized groups that we've defined as revenues between $25 million and $1 billion for mid-sized companies, annual revenues in excess of $1 billion for large enterprises. So we'll be drawing on information from companies with a wide variety of backgrounds. And who do we talk to? Well, as you can see, 62% are senior-level professionals. These include treasurer, assistant treasurer, controllers, C-level, and director level. And are from a diverse set of industries. They're predominantly from manufacturing, followed by the banking, financial services, and insurance industry, as well as energy and utilities. The other industry category that you see here, they vary from construction to technology services, holding company, etc. So it's with that background, let's take a look at some of the interesting highlights of the study. In our research, we found that more than 1 in 3 companies, or 37%, ran reducing costs as a primary driver for a payment factory. Now, this is not surprising because, as we are all aware, companies are continuing to adopt a back-to-basics approach, with departments demanding more operational discipline from their teams. The account payable as well as the accounts receivable functions are ideal starting points for centralization, because we all know there's manual effort expended in typically a paper-based and labor-intensive environments. Secondary pressure that we can see here that emerges as a key motivator for a payment factory is improved visibility into a company's cash resources, and cited by 27% of all respondents. Administration is inherently efficient because it's streamlined reconciliation. There's more visibility over cash positions of not only the internal business operations, but external financial value chain as well. And related to the issue of improving visibility is the need to improve transparency and reduce risks, such as fraud and payment errors. But what I want you to note, looking at the slide, is that while 11% of European businesses indicate consolidation of banking relationships or analyzing bank accounts a key reason for a payment factory, this is only true for 6% of North American respondents. European companies, well, they have cross-border activity and wide-reaching business units, subsidiaries, and suppliers, so corporations must often grapple with a complex mix of banking relationships. And there's lack of clear perspective of the financial state of an organization that can prevent quick and accurate decisions in response to changing market dynamics. And when you couple this with an ideal credit market environment that we have today and limited forecast abilities, companies need to maintain more cash on hand to cover this uncertainty. I also point out to you some of the catalysts based on the size of the company. Well, first of all, business transactions involve companies with different resource levels, technical capabilities, and risk appetites. For this reason, the most frequently cited motivating factor for a payment factory varies by the size of the company. For enterprises with revenues in excess of $1 billion, the emphasis is on operating costs. And as you'll note on this slide, 34% of large companies cite cost reduction as the leading reason for a payment factory initiative. Because enterprises, they deal with mergers, acquisitions, divestitures, lengthy vendor files, disparate billing systems, and to financial functions that only have a partial view into their cash. And as a result, it makes it difficult to accurately predict cash requirements. An integrated and centralized approach offers lower costs, both for internal as well as external economies of scale. Now look at mid-sized companies. The business driver behind a payment factory is the need for consolidation of banking relationships or the reduction of bank accounts. As we know from this slide, that's indicated by 41% of respondents. Businesses that maintain multiple banking partners, they operate hundreds, sometimes thousands of bank accounts, and enter them with proprietary connections and assistance to send and access banking information. This can be a daunting task and invite exorbitant bank fees, loss of visibility, and risk issues that are associated with internal controls and corporate governance. So a qualitative view of accounts and funds can permit a more nimble response to evolving business issues. And then you contrast this with the dominant pressure in small companies that you can see from this slide. They're motivated in improving transparency and reducing risk from fraud and erroneous payments, which can be costly because one shock to a company that's a small business can put their business in jeopardy. And related to the issue of risk, John Farrell actually is going to discuss counterparty issues in more depth later on in this presentation. This slide highlights that the majority of the companies, or 62%, have shifted towards implementation of a payments factory, whether live, under consideration, implementation stage, business case and development, or selection process of consultants and or solution providers. And more so in North America than in Europe. And as we become much more globalized and the international trade continues to grow, traffic and payment volumes will also increase. Couple that with the technological advances that exist today, especially with the development of web-based platforms, it's make centralized structures much easier to implement and facilitate. So companies implementing payment factories. I'm going to turn it over to John Farrell, who will discuss the implementation models and delve deeper into our other research findings.
Yeah, to follow up on that question of how companies are implementing a payments or collection factory, the thing is they're on the road to centralization. The corporates turn to a range of choices. They can be in-house, they can outsource it to a payment processor, outsource it to their banker, or other hybrid models. Establishment. Overwhelmingly, 2 of the 3 companies have implemented or plan to implement a payments factory in-house. This adoption, the adoption of types of implementation models drops considerably to 9% when outsourcing to a third-party payment processor. In the other category, many respondents were of this hybrid approach. That is, some in-house, some outsourced, possibly delineated between the payments, between the payables and the receivables side. What's interesting is that very few of the companies plan to outsource their factory to the bank. And I think that it shows that bankers need to do a good job of educating their corporate customers on the capabilities that they have in centralizing and managing these for them. So if we look at the counterparty risk question, this slide clearly illustrates the importance of counterparty risk. For companies, it is important or very important for them to de-risk their supply chain. It moves to 90%, and companies, the companies who felt that this was not a relevant question for them. And credits as it improved, there's still an awful lot of awareness about the impact on customers and their ability to make payments. And raising the increasing risk of potential supplier and customer failure, companies have been in more rigor in assessing the health of both its suppliers and customers by looking at a host of metrics and making organizational and operational changes. There's requests out there to accelerate terms. A significant benefit of streamlining the entire process with a payments factory is that businesses can negotiate better terms and pricing from suppliers to maximize the capture of early payment discounts or dynamic discounting. Companies are also leveraging supply and finance solutions in partnerships with banks or third-party solution providers. So suppliers are paid early, aiding in their cash flows, while buyers benefit from cost savings, increases in working capital, and strengthening of these collaborative relationships. Next slide, Pat. One of the things we asked in this survey is, how do you rate your banks? And the good 75% of the corporate businesses out there positively rate advice for banks. This is more North American customers rate their banks as excellent in Europe. Part of this thinks attributed to the crunch as cost of capital, maturity shortened, and fee increases. Companies realize they need to work more closely with their banks. And if we get the next one, we also look at this in terms of company size. So it's interesting to look at this based on the annual revenue of these corporates. At opposite ends of the spectrum are small businesses that rate banks' advice from excellent who don't even consult their financial services partner. In contrast, 76% of mid-sized companies and an equal number of large companies rate their advice as good or excellent. Businesses in North America rate their bank partners positively. Clearly, there's a need to educate and provide value-added services for automated systems that connect seamlessly to a client's in-house system and treasury management systems, and designed to permit transparent reconciliation and provide time access to balances and statements, will provide more control over payments and create a solution to ease the corporate client's payables and receivables. This speaks directly to some of the previous slides that Ned spoke about with the drivers that these corporates are focusing on. If we like that, we have a couple of pointed questions during this survey, and we'd like to just address them right now. The questions we asked was directly related to the value of this SEPA initiatives going on in Europe right now. So as you must know, the SEPA end dates or go-live dates are approaching, and by placing Europe's current patchwork of payment schemes with a single approach across 32 countries, the landscape in Europe will make it easier to centralize the payments processes across European subsidiaries. We need to ask, can provide competitive advantages. To date, it's been erratic. The last of them is due in part to the lack of clarity. They can really divergent views on SEPA. Some an onerous compliance-related risk, while others view it as a to remain competitive. The treasuries are looking to the financial institutions to leverage SEPA, are often confronted by confusing messages. For this reason, it's not surprising that 32% of the survey corporates are unsure what SEPA even means for their business. Corporates, which suppliers and partners use the instruments, view SEPA as a burden with little or no benefit, as cited by 13% of the respondents. However, there's a compelling reason to migrate to SEPA, highlighted by 43% of the respondents indicate an opportunity for business benefit. Indeed, the range of benefits and opportunities that SEPA offers include potential for reduced bank account management, effective and more reliable payment processing, third-party risk, efficiency, including payment automation, consistent payment terms, conditions, and procedures across Europe. It also offers a holistic snapshot view of payments and accounts across the region, and it will allow cash cash forecasting and liquidity management. So what does this mean to when you're talking to your clients about SEPA? We need to provide a clear message to your corporate clients. sound technical implementation support, having a solution for file format management, and demise automation to facilitate a smooth SEPA implementation process. Also provide solutions rather than utilizing, say, SEPA direct debits on a blanket basis, adopt domestic direct instruments in certain countries or situations where appropriate. Being at payments factories, we're also interested in the evolving regulatory landscape and what it means for corporates and financials in the U.S. And ask the direct question again on corporates' views of same-day ACH. So as many of you know, NACHA, the leader for automated clearinghouse transactions in the U.S., is proposing amendments to its operating rules to introduce a new expedited processing settlement option. In the quarter of 2010, the Fed wrote same-day service limited to certain consumer ACH debits, consumer checks converted to ACH, and consumer debts initiated from the Internet and telephone. Anticipated to accelerate ACH traffic. The meager adoption rate of the Fed ACH service offering is sobering. A natural rule could change all that. It would make participation by all networks, both the Fed and the clearinghouse, by having a depository, by all receiving depository financial institutions, more significantly, move certain consumer debits to support consumer, corporate, government, and cross-border payments with potential limitations on the dollar size of the payments. Left around the ACH can be learned from around the globe. Nico was instrumental in the UK Faster Payments Service, which launched in 2008 and is somewhat parallel to the ACH efforts we're seeing here in the U.S. Despite opt-in participation, according to the Payments Council, this year Faster Payments reached a milestone and processed over 1 billion payments. It's opening up opportunities for innovation. Institutions that are taking advantage of this new channel stand to make gains in overall customer wallet share and increase both their retail and commercial customer base. With ACH offerings in the U.S., mobile payments such as P2P and person-to-business can become a more viable channel. In turn, banks will be able to reinvent their business model to benefit from these capabilities. From this, it's clear that businesses face same-day settlement, especially for transactions that they don't feel warrant wire, but warrant the added expense for a same-day ACH. For bill, same-day ACH transactions can help identify more quickly return transactions, although unlikely that the bulk of ACH payroll and pre-authorized debit programs will be altered. Other benefits include concentration activities as well as responding to late or failed payroll obligations. Financial institutions are aware of additional costs with the change, especially those tied into old technology. NACHA is actually trying to limit implementation costs by leveraging existing ACH windows and infrastructure. Financial institutions who consider the benefits of faster settlement include supporting technology investments in competitive strategy going forward. The question we asked was directly related to international ACH transactions. So in September of 2009, that was a pivotal time for the ACH network. On that day, the operating rules became effective, enforcing all international payments made through the ACH network to be identified via a standard entry class code known as AT. This change affects corporate pay initiators, financial institutions, third-party financial software vendors, and pay service providers. Under rule, IAT entries became subject to OFAC screening. The rule also requires that IAT payments include specific data elements defined by the Bank Secrecy Act's travel rule. The ignoring those obligations are both criminal and civil and include both time and fines ranging from $10,000 to $10 million per occurrence. If these fines are levied against financial institutions, they may pass back to the corporate originator depending on the specifics of the case. Last September, NACHA passed additional modifications and requirements. IAT entries for passage in March 2013, coupled with the rise in the number of cross-border ACH transactions, we ask where initiators in the implementation process. So we need to note that 2 years after the passage, excluding those corporates for whom it's not relevant to their business. Only 36% are live, 14% in the implementation stage, 30% have a business case in development, and 11% are in the review or selection process of technology providers. So we would like to conclude with a few key takeaways from the research. And centralizing project and monitoring for corporates. It's important for banks to educate and advise. There's a disconnect between the ratings of financial institutions and the services actually utilized by corporates. Messages need to be clear. SEP is a great example. The SEP has divergent messages, creating confusion in the marketplace. So feel it's important to educate key internal stakeholders to provide holistic solutions and to collaborate internally to bring the siloed products and services offered. And then provide value add, offer a mix of products and services that provide flexibility to corporate clients. So thank you very much. We're going to open it up for questions. I know you are familiar with Logica when you're coming on the call, and if there's any questions, I'll turn to Pat.
To draw your attention to some Logica resources available to you. You can read Labs, the Logica payments product that helps transform your disparate legacy payment systems onto a payment services hub for all types of payments, be they retail, wholesale, value, high value, urgent, or time payments, to help be more agile in bringing new products to market. We have thought leadership pieces on current topics such as a subject on payments factories and same-day ACH. Links are provided on this slide. We're sending a copy of the presentation to those who participated in this webinar. All on the lookout for the research report based on the results we have shared today that will publish in a few weeks. I'll open it up for questions. We have a few questions that came in during the webinar. First is, can you early payment discounts versus dynamic discounting and supply chain finance?
I'll take that, Pat. So early discounts, it's explanatory. Buyers can negotiate better terms and pricing from suppliers to capture early payments, as John explained earlier. And then in terms of dynamic discounting, that's a form of early payment discount. And these discount programs, they can be changed as the cash flow position of the buyer changes. In other words, the percentage of the discount decreases the closer to the normal payment date for that transaction becomes. And the flexibility of the payment terms then allows corporations to support the needs of their main suppliers while mitigating the potential financial chain disruption or counterparty risk that John was speaking about earlier. And then in terms of supply chain finance, that can enable a company to use its financial strength to provide financing to suppliers at a much cheaper cost than they could negotiate with their own banks. This form of credit arbitrage actually works across borders where it may be expensive to borrow and provides supplier partners reduction in finance costs and secure supply.
We see additional questions that are coming in, and unfortunately we've run out of time. However, we'll respond to each question via email. If you have any additional questions for the speakers, their contact information is provided on the slide. We have your time and look forward to working with you. Thank you, everyone.